Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and watching the Market Chameleon pre-market webinar series. Before we get started, let's take a look at the shared disclaimer. Be aware neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only. Before we get started, take a look at that disclaimer. I'm going to see what's holding Dimitri up coming to the stage. Keep looking at the disclaimer. Hey, Dimitri, you hear us? I see you're muted. Dimitri, you there? Ah, there he is.
Hey, well.
Hey, so you're
Good morning.
live, buddy.
Okay. Good morning, everyone. Are you well?
Good.
Let me share my screen here. And what we'll discuss today is how to use a visual chart to look at the implied volatility smile of an options expiration, and then how we could compare different expirations on the same graph. So let's use SPY in our example. Type in SPY in the search box, and you come to this main page. On the left-hand side, there's a menu. Click on volatility, and then click skew. And I think we hear your background.
All right. You remove.
When we come to this skew page, and on this skew page we have different tabs that allow us to analyze the skew from different perspectives. And we're going to click on this compare expirations tab. Okay, and let me just close this menu to expand our screen. And here we see this graph. There are three lines here, and just by default, 3 of them are selected. And then we could change the different expirations, but these are different expirations, and it shows us the implied volatility of each strike that are available to trade. So you could see here, cuts it off probably all the way at the tails, but you could see here these are the lower strikes starting from 450 going to 560, and it takes the implied volatility of that strike using the weighted average between the call and the put, the implied volatility, and then it plots each strike for these different expirations. So we have the April 10th expiration that expired yesterday. So that's no longer relevant. Then we have the April 14th, which is this yellow line here. And then April 15th, that is the other purple line below. Let me just remove this April 10th. So now we have 2 expirations that we could compare implied volatility skew and smile on the same graph. If we wanted to add like maybe a longer term one, let's say May 16th, you click on this box, and that will draw another line for the implied volatilities for that May 16th expiration. Now we have all 3 of these plotted on the same graph, so we could compare how does that implied volatility look like relative to each other. So here we could see clearly that April 14th, entire implied volatility smile is above the other two. So the implied volatility on each of these strikes on April 14th is higher than April 15th, and the April 14th and 15th is higher than May 16th. So right away we know that the implied volatility uh, uh, term structure, right, slopes down, starting higher, going down. Each, at least based on the three expirations that we selected. So there's more uncertainty priced in the shorter term, right? So and which makes sense because right now we're in a very volatile period, because there's uncertainty with tariffs and where this will end up, until it gets resolved. So there's a lot of uncertainty in today's markets. We're seeing a lot of volatility, and this would make sense that the shorter end of the implied volatility term structures is higher inverted, right? Because we're seeing a lot of short term or immediate volatility in the market. The other observations we could see is how the implied volatility smile within each expiration looks like. So here, if this really dark line over here, this shows us where the current stock price is. So this way we see how the strikes, right, around the current stock price look like, where they're split, and what the implied volatilities look like as we go up in strikes. So as we go to the right, higher in strikes, and from this current spot price, if we go down in strikes. So what this is showing us as well, how does the market price in volatility expectations as the stock is going down, and how does the market price in volatility expectations as the price is going to, if it moves up from here, right? So here we could see that based on the market, if the stock moves higher, right? And so from this reference line, if we start moving higher to the higher strikes, the market is implying that the volatility will start to decrease, right? That's what this implied volatility terms said, that there will be more certainty and volatility will start to decrease. If we go down from here and the stock starts going to lower and lower strikes, then the market's expectations are that the volatility will start increasing. It'll be less liquid, right? More uncertainty. So and we're going to see larger and quicker gyrations in the stock market, right? Because SPY, that's S&P 500, and that shows the same across the board. The shorter term, right? We're going to see in the shorter term, if we go down now, we're going to see, much higher. You could see how quickly that curve moves up, how it slopes, right? So we could just see that from the chart. And we also see that there's a significant difference in the implied volatilities as we move across expirations. So they're not all the same. Here we're way higher, right? Around, if you hover over, you could see 57.9 on April 14th expiration versus 34.1 on May 16th. So there's a big skew horizontally as well. We could kind of see that here. Here's the at the money implied volatilities, and just by this table as a reference, we could see how the term structure and at the monies look like. Okay. So there's one more way to look at it, and this is looking at it by strike. Okay, so all these this chart is plotting implied volatility by strike, so we could compare strike versus strike, right? If we wanted to compare if I hover over the 540 strike, we could see how the implied volatility is on the 540 strike in May 16th, April 14th, April 15th. So as we hover over, you're doing it strike by strike. We could also look at it from a different perspective, and that's by delta, and that normalizes it a little bit more, because by delta takes into consideration your cost of carry component, and it also looks at the delta versus delta relative to the at the money implied volatilities. Okay, so let's take a look at that. And you see here, you could toggle down here, and we're going to now normalize this curve by delta and see what that looks like. So here's by delta. Okay, so down here, this is based on the call delta. Okay, so here's a 1 delta where the call option moves 1 for 1. If the stock goes up $1, the option is expected to go up $1. If the stock goes down $1, the option is expected to decrease by $1. This is your 50 delta in the middle, and then it goes up to 0 delta where the options are basically priced worthless and no delta. Okay, and what this does is it normalizes things for us in a couple ways. One, I mentioned the cost of carry. What does that mean? Is that a stock price today, right, is worth, the spot price of $524, right? Let's say that. But the forward price is different based on the interest rates and the dividend expectations. So that's your cost of carry, or maybe even your borrower rate. And it's kind of like, think of it, what the present value of money is today versus the present, versus what, if you go out in time, right? Like, what is it where today, if you're out a year from now or 2 years from now, because you have, the time value, the present value of something today based on the interest rates that you would get. So interest rates play a big factor in it. You're foregoing, if you're buying a stock for $524 and you hold it for a year, well, there's a opportunity cost to that money because it would earn you, let's say, 4% over the year. And what about the dividends? Well, you're going to get dividends for stock. You hold a stock and you have dividends, but the option holder is also not entitled to a regular dividend. If you have a call option, let's say that's in the money, well, the company pays out dividends to shareholders. It doesn't pay out dividends to option holders, right? So if you own a call, you don't get a dividend. You're not a shareholder in a company. You have the right to convert it to shares, but it's just a contract between two people. So now you have this contract, and if the contract doesn't have a stipulation that I'm going to pay you a dividend, like a substitute dividend, well, you're not going to get a dividend from SPY, the whole or whatever stock you have an option under. So you have to take that into consideration, right? All those, because if you're doing an option instead of a stock, you're gonna forego that. So this is all priced in to the options and will be reflected in, and then we could compare those deltas, right? Well, 50 delta option in April 14 expiration will be a different strike. 50 deltas will be a different strike in the May 16th. And it'll be a different strike in, coming out September 19th because of the cost of carry component. Okay. But here, but it's still a 50 delta option. So here we're plotting it based on those deltas. So now we lined it up. We lined it up now to be able to compare those for you. So here we see that, yes, even when we do by delta, that the term structure, right, the term structure still slopes downward. We have more uncertainty in the shorter term than in the longer term. And well, the inversion is because we have a lot of uncertainty in the shorter term. We also see that the tails on each of these starts to slope faster up. So you could see here we're kind of slow, a kind of steady slope as the stock goes down, and then if we get down here, we're going to, the tails are really starting to curve up. And we could also observe that just by delta, as we're moving to lower deltas in the calls, implied volatilities are moving down, meaning that that from here, if we move up, then it'll be based on more certainty, and volatilities will start to climb in, right? And by the way, this isn't always the case, but this is what it looks like. And in SPY does that slope. Usually that's what it does. As you move up, it slopes down. As you move down, it slopes up. But that could change, and for different stocks, it could look different. Some stocks, if let's say biotech stock, right, though that upside could look like this, because if it announces something, it could be a very fast move up, right? Or if a stock is expecting maybe some kind of a, announcement from a lawsuit, or waiting on maybe some kind of a like research that the results, anything like that, where if there's good news, that the spike up could be very quick, right? Just you could have illiquidity to the upside, just like you could have illiquidity to the downside. I mean, we just recently saw illiquidity to the upside, actually, in SPY, when there was an announcement that there was going to be a pause on tariffs for 90 days. The market was up 10% in a matter of like a couple hours. So, and the markets, we're not even pricing that in or expecting something. It was a very big surprise, right? Like all of a sudden, out of nowhere, there was a pause. So now we're getting like news out there that isn't telecast ahead of time, right? It's not like sometimes you have news telecast ahead of time where it says, well, on this date we're going to make a decision of this or that. But if you get some news all of a sudden that wasn't telecast ahead of time, could be very big market movement. We've seen illiquidity to the upside as well. Right now, the way it's structured is that we don't have this tail to the upside pointing up as of now. So, well, I think I'm going to stop there, because I think I covered enough from this page to give people a good idea, of the insights.
That's awesome, D. Very helpful and very informative. Thank you so much. I'll remove that. It's Friday, so everyone have a safe trading day out there, and really be careful with this volatility. It's, to say the least, very interesting out there. D, great job as always. You have a great trading day, everybody. Remember to like us, follow us, give us some thumbs up on YouTube. That's always helpful and kind. Great job as always, D.
Thanks, everyone. Have a great trading day, and we hope to see you Monday.
Stay safe out there, chameleons. Everyone have a great day and a great weekend. We'll see you on Monday. Bye-bye.